This is an audio recording of the Lendit Fintech Weekly News Show. The show is streamed live on Lendit TV, LinkedIn, YouTube, and Twitter at 5 p.m. Eastern Time every Thursday. In this fast-paced show, the Lendit News team and a special guest discuss the most important fintech news stories of the past week. Good afternoon, everybody, and welcome to the Fintech Nexus Weekly News Show. My name is Peter Renton, Chairman and Co-founder of Fintech Nexus. Joined this week, as always, by Todd Anderson, my good friend and colleague. How are you doing, Todd?
I'm well, Peter. How are you?
Good to have you back. I know you had to duck out on us last week, but good to have you back today. Dan Kwan is our special guest today from Nevcourt Ventures. Hope I said that right. How are you doing, Dan?
Great. Good to be here again, Peter and Todd.
Yeah, good to have you back, Dan.
Good to have you back. And you're coming at us from Jacksonville, is that right? Or just outside of Jacksonville?
Yeah, Ponte Vedra Beach. Yeah, we had a little bit of hurricane party fun last week, but we dodged the bullet.
Yes. Well, I'm glad you guys are all safe and that you did dodge a bullet, because that was a pretty horrendous hurricane. So let's get right into it, though. We have a lot of news to get through. So first thing I want to talk about today is this is something that was in the Wall Street Journal. The Financial Stability Oversight Council basically has warned that crypto could become could threaten the financial system, could grow and create systemic risks. 120-page report was released, very much about talking about how if it grows dramatically, then they're going to be intertwined with the main financial system. It could become a problem. Now, there was very little talk about how the opportunities that it presents, much more about the vulnerabilities and the potential challenges. So what did you guys think of? I must admit, I didn't read the whole 120-page report. I read the Wall Street Journal article.
It will
Dan,
be amazing.
I'd be curious to hear your thoughts, Dan, as someone who used to be in the throes of a government agency. From
the inside, yeah. Well, So first of all, listen, there's nothing new in this report, right? So when FSOC, obviously their mandate is just to look at the financial stability of the nation. So everything that's coming out there is going to be about big warning signs. So which is not surprise. This is my first point. The second point is really, I think so. So they use the word of would. So sure, yes, of course. We saw the demise of Three Arrows Capital and the Terra USD. Lots of investors lost shirt, but interestingly, there was no government bailout, right? And do people forget LTCM, Long-Term Capital Management, back in 1998, right? 12 large banks came together. Called for by it was orchestrated by the New York Fed, and not to mention 2008 financial crisis where Lehman Brothers actually went belly up. So Bear Stearns. So I think in the grand scheme of things, we're still seeing these are sort of little crises probably in the making, but far away from being a stability issue for the financial system. But I think the most important thing here is, I'm sure we're going to talk about other news on this show, is really the fact that crypto is really in Web3. It's really in its very, very early stage. So most of the activities that related to sort of these this crypto winter, or we have had 2 winters so far, is really the crypto assets have been used mostly for speculative, and we haven't seen any real life application. And getting back to your point, Peter, about the benefits, I think that's where probably will take still some time for the benefits to be realized. And at that time, I believe the risk will be dialed down because you have less speculators trading on cryptocurrencies, and it's really about how we can use the power of blockchain to help the real economy.
Mm-hmm. I think so far, to pick on your last point there, Dan, a lot of the talk and a lot of the focus in the at least the stuff that the government has put out and some of the agencies have put out has been very much on that speculative asset piece of it. If you talk to people in the industry where they think the biggest value is the potential that the underlying technology can have on back offices and settlement and custody, and it's become significantly cheaper, more traceable, more trackable, versus maybe some of the systems that are out there today. I mean, when you put a block out there and the immutable nature of it. And so I think so much of it has been on the speculation and some of the issues that have derived from that, which, to be honest, some of it's people issues in taking risks that they probably shouldn't have taken, or taking risks that just didn't pay off. And so I would hope, as we continue to see adoption, especially amongst the big banks and the big asset managers and others, that the conversation begins to shift a little bit away from just speculation to, kind of the whole of what the technology and the industry might bring to financial services.
Right. And we are going to get into an application here in a little bit, but I want to go into our next story, which is another regulatory story coming out of the White House, the blueprint for an AI, artificial intelligence bill of rights. And there was an article, I think it was Penny Crossman in American Banker wrote about it. There's lots of people wrote about it. They basically laid out six different rights that consumers have. And this is just a blueprint. It's not legislation, but it is a suggestion, and basically talking about consumer protection and the ability to opt out and different things. I won't go through all of them, but maybe Dan, I know that you're our regulatory expert, and there's so much regulatory news these days. What do you make of the blueprint here? I know you sort of have done a bit of work around AI and lending, which was mentioned in this report as well.
Right. Yeah. So, I mean, I've seen, I think Protocol reported that some advocacy groups were not happy with the Bill of Rights. They want something to be more prescriptive, to be more substantive. But I mean, come on, it's just the White House. They have no ability or authority to legislate or to prescribe, regulations. It's not their job. So I think the White House did what they had to do, which is really providing a blueprint so that other agencies will take heed of their priorities, their recommendations, and if appropriate, they will write their own regulations. And if Congress heeds their recommendation, they can start writing, proposing bills. So I think so. Nothing in the blueprint, I skimmed it very quickly, sort of jumps out as a surprise, right? On the privacy issues, on the ability to opt out, on the ability to, be aware that, the data is being used by some, AI system, and also obviously on the fairness side. I do think so far, at least on the financial services front, the regulatory agencies have taken a pretty cautious approach. They have never really done any wholehearted endorsement. And they always tell, hey, there are risks, but I think it's really upon the industry, upon the practitioners to really figure out a way to prove them that the AI system that they have deployed, they have invented, are truly fair and equitable and can truly expand access to credit. I think there's still a lot of work that can be done. We don't necessarily need a new legislation or regulation to really make sure AIs are more fair, because I think the law is the principle that guides the pre-AI world should be no different from the post-AI world.
Mm-hmm. Mm-hmm.
Yep, I would agree with that.
Okay, well, we're gonna stick with one more regulatory story before we move on to the rest of the discussion. This was an article in Bloomberg. Crypto overhaul fizzles in Congress, leaving industry and
what a surprise.
Yes. Well, as always, I mean, I think there was a bit of optimism because, particularly on stablecoin legislation, there was a little bit of optimism at one point this year that something was going to get done. But there's nothing that's going to get done. I mean, now we're what are we? We're a month away from less than a month away from the midterms. So there's clearly, then you're going to have a lame duck Congress, which is probably not going to be a high priority for that. So yeah, basically, the other piece that this article made a point of, which I thought was important, was these legislators. This is some complex things that they're considering here, and they do need time to understand these complexities. But anyway, so you think we're going to get something in 2023, Dan?
I'm not sure. I mean, 2023. I mean, that's just, I don't know. That's just, I guess I don't want to predict the outcome of the midterm, but it seems to be, it's likely that the Republicans are going to take over the House. The Senate probably is still a coin toss. I do think McHenry and the Waters actually have been working actually quite cooperatively with each other to propose this bipartisan bill on stable coins. But I'm not sure what the future will hold in the Senate. Not to mention the White House still needs to sign. So I'm not actually that optimistic. I'm still thinking probably things are still going to happen, and Congress still going to move very slowly until probably there's another big blow up. I hope not, but Congress doesn't move until there's a big existential threat.
Right.
I wonder if you'll see, as we're kind of still in the crypto winter, but if we see another bull run, will they try to get some ahead of a potential collapse and not wait for it? I think that'd be interesting if kind of we start to go on this bull run and prices begin to spike, and the speculators are out, people are making lots of money, and before that crashes in either a big or a small way, if regulators are like, oh, here we go again, should we kind of put something together? I'd be curious if that would happen, but I generally speaking, I agree with kind of most of what you said there.
Yeah.
Well, I mean, maybe going back to the FSOC report, so the interconnectedness nature, where if the incumbent financial institutions are getting to cryptos, and if they actually are losing their shares in the bubble, and that causes some kind of a bailout, I think that will be tremendous amount of incentive for the Congress to act quickly. Otherwise, I still see there's so many different interest parties at odds with each other. I'm not really optimistic.
Right. Okay. Well, let's move on to some actual application of distributed ledger technology that we have found out about this week. Customers Bank, Cogent Bank, and Western Alliance Bank, and none of these are small banks. These are all tens of billions or multi-billion-dollar banks. They did $500 million in transactions, 400 transactions sent across this new network, the Digital Interbank Network. It's a permissioned ledger that was built by the Tacit Group, and this is basically a private fork of Ethereum. So it's a private blockchain that's shared just among banks, and they did these transactions close to real time. I think it's a really pretty cool use of blockchain technology, and maybe this is where banking's going, into more of these private type systems. But what do you guys think?
I mean, that'd be one of the other, besides the the kind of ultimate potential interconnectedness of the different protocols and networks, how banks utilize private and public, and how that begins to work itself out. Because obviously the private networks allow them to have a lot more control and security, and less conceivably less worry. But there is going to be some level of probably need for public blockchain in terms of the customer facing applications and stuff like that, and how do they deal with the two dynamics together, I think is an interesting issue that banks are eventually going to run into. But to me, I think this is a positive. The more banks that do stuff like this, I think the better, and the more that regulators can learn about the powers of the technology, because ultimately when the banking system is using it, then they also have to act on it.
Yeah, so I generally speaking, I agree with Todd, your assessment, but I'm also sort of concerned about sort of the fragmentation issue here, which is what I mean by that is that you have FedNow, which will hopefully come online in 2 years, and you have already the clearinghouse has its own RTP, right? So real time payments are actually happening, just not just in a small scale, and hopefully when FedNow comes online, we have a much bigger scale. And you have these some banks that form their own consortium, the USDF consortium, for example, right? They could theoretically also use their own blockchain to facilitate the real-time payments. How will these different private permissioned blockchains actually work with each other? I think that's going to be, regulators are not going to really vote on it. I think ultimately it's going to be the market, which one will have more traction and which one will be, the more popular or prevalent protocol for banks to use.
Yeah, I mean, there maybe end up being this new subsector created of integration with all of the different.
You just stole what I was going to say, which is, who's going to be the next innovator that figures out the layer that fits between the different protocols, public and private, Ethereum, Bitcoin. If someone can figure that out, then if you can have the connected tissue in some way, and there's like a security layer of approval or denial, I think it opens up a lot of possibilities.
Yeah, and I think that's got to have to happen because the real-time payments,
eventually,
there's already RTP and Fed. When FedNow comes out, there's going to be that. I think it was US Bank or someone's done some work on interoperability between those two. But but by the time FedNow comes out, these other systems are going to have more traction. So I think there's going to have to be some There's going to have to be an infrastructure layer built, I think. Okay, moving on to buy now, pay later. We haven't talked about buy now, pay later very much. It was so hot just a little while ago, but we had some news from Afterpay this week, the Aussie company that is owned now by Block, and they are basically, they basically invented the pay in 4 type product that's used by many BNPL platforms. They're now going out with new monthly payment options, 6 and 12 months. Ticket sizes. The ticket size for Afterpay for these 4, they're in the low hundreds, and now they're going to $400 to $4,000 for these ticket sizes. That's getting into like a firm's sweet spot. I could see where they felt like that was probably an important market that they were ignoring, and no late fees, no compounding interest. So they're putting this. Apparently, it's available online with selected retailers right now, and it's going to be offline next year. So, Afterpay moving into a firm's turf, it looks like.
So it's a real credit product, right? Because it's more than 4 payments now. You have to do all the truth in lending disclosures and the chargeback rights or what have you. It's interesting. What does it mean with no compounding interest? But they are charging interest, right? I believe. So probably simple interest they're charging?
Yeah, I think it's simple interest.
Yeah. Well, I mean, listen, this is a good thing, right? So, I mean, what it means is just more options for consumers, right? So credit card versus BNPL versus this is extended version of BNPL with slightly twist, still transparent disclosure, transparent fee schedule, no fees, which is good, and the simple interest. So it's good.
Yeah, I think it's just a natural evolution of their product, just to widen the reach that they have for the different types of transactions people want to do.
Yeah, and they've left it to a firm, that whole market, like a firm with Peloton. That was a huge part of their business for a long, during early days of the pandemic.
There is another player in that the more the higher ticket items. I think it's OPY.
Right.
They do the higher items, a few $1,000s up to, I think, maybe 10,000. I forget the exact numbers, but there's starting to be a little bit of competition in the higher end of the space.
Right. Okay.
It's really interesting to see. Sorry, just one comment was getting in here, Peter. I think it's really interesting to see all these, point of sale innovations, right? Obviously, Afterpay started as a paying for, buy now, pay later trend. Then you see, upgrades, you really using installment feature and putting on a card, not credit card. And I think banks, they just have to compete and come up with something similar to counter these these are new products.
Right. Okay, I want to move along to our good friend Ron Shevlin, been on the show many times here. He did a piece, it actually came out on Friday night, which was interesting timing, but anyway, talking about a new survey they did at Cornerstone Advisors about fees. And there's all this talk, consumers hate fees and thinks overdraft fees has been a huge movement in the last 12 months. I've been very much behind that movement as well of getting rid of overdraft fees. But what they found in this survey was that people don't think there are really hidden fees in banks that much, and they also think that the bank fees are fair, which I think is really interesting. And like when you overdraw your account, people expect they should have to pay for something, pay a penalty for that. But anyway, he goes on and talks about fees are not the problem. It's really liquidity management. And he comes out with a whole bunch of different ideas there, which we won't go into. But I thought it was the first sort of anti-fee kind of article I've seen.
Well, I mean, quick poll here. Any three of us, does any one of you guys like fees, paying fees?
Like paying fees? No.
No one likes it. I think you still, we all, how many monthly fees, how many monthly subscriptions do we all have? I got a couple of dozen, I think. Yeah.
But I think, I like Ron. I like his research. I like his op-eds on Forbes. But I think he kind of missed the point here, right? So one thing he talked about disclosures, transparency. So I don't think there's a disclosure issue here. Everybody knows if you overdraw your account, you're gonna pay a fee. The problem is really like even if you know, but you still don't know when you're gonna overdraft, and that comes as a surprise, even though it's not a surprise, and nobody likes that. And but I agree with him that liquidity is a real issue here, right? So you can kill overdraft fees. You can say banks you shall not charge fees. Okay, banks will say, okay, I'll follow, I'll listen. But then you stop people from overdrafting accounts. Then if they still have, and I'm sure they do, the legitimate liquidity need, where are they going to go to? Are they going to go to a payday lender? Are they going to go to other pawn shops? And I'm not saying overdrafts are better than those products, but I think the core issue here is with high inflation and more Americans are living paycheck to paycheck, according to this recent Lending Club survey. So killing fees really probably helps, but I think more importantly, how can we help these people with their liquidity need in the short term?
Yep.
Yeah, I think. And so, I mean, I probably fall more on your side, Dan, in terms of Ron missing the point. I think, it is interesting to hear some research where people think some of the fees are fair. Like if they do overdraft, they think that there should be a charge for that. They shouldn't just get it for free. Now, the point of, if you had 3 transactions and the bank choosing which one is the one that puts you in overdraft, to me, that would be hidden because they're not transparent about how you got into overdraft. I think overall, the fee issue is certainly a lot more bluster to it in some ways because it's something easy to jump on in Congress and amongst agencies. But the heart of it is liquidity and how also the point that you made. If you're at the register and you can't overdraft, that experience on a customer is also hurtful.
It's horrible.
If they're sitting there going, "Oh, my card's not working," versus, "All right, I'm $5 over a thing." Like, what's the better version? Because either way, you're hurting the customer in some way. But it's not a simple answer to the equation.
Yep. Okay. Moving on. This came out this week. Cabbage sold to American Express. We all know about that in 2020, and they formed this new unit called KServicing, which was to basically service the existing portfolio. Now, most of Cabbage's loans are fairly short term, so they are, they're paid back within 12 months, and this was middle of 2020. But we just found out that KServicing has filed for bankruptcy because they also were servicing the PPP portfolio. Now, Cabbage did a huge number of PPP loans, 300,000 loans, and did a tremendous job, I think, in getting those out the door in really quick time. But they've had some challenges. We all know there's been PPP fraud, and Cabbage probably had more fraud than the typical banks had. But I was surprised to see this. I mean, the PPP portfolio is now $1.3 billion, but they're basically saying that it's been so time consuming and resource consuming to answer all these federal and state investigations that they needed to take this step as how it looks.
I have lots of sympathy for the Cabbage guys, and frankly, for any of the fintech lenders during that time. I mean, choose your poison pill, right? You can choose not to lend, and there will be no fraud, and then you're under tremendous amount of pressure to lend as much as you can.
Right.
Then you open the gate, and all the fraudsters just came in and tried to steal money from Uncle Sam. So as much as we believe, our fraud detection tools are so good, obviously, people are smarter, scammers, fraudsters are smarter than what we think. So exactly what do you want them to do, right? I mean, you've seen some banks being criticized, large banks being criticized by advocacy groups, by the regulatory agencies, by Congress for not lending enough, and now you lend more than you could probably in some cases. Then you obviously fraud issue is front and center now. So, and I'm not saying the agencies shouldn't investigate fraud, but at the same time, think about, if we have to relive 2020, think about the crazy time when COVID was on the rise and small businesses were dying and the people just wanted the money.
Yeah, so, they needed it. They couldn't wait even 2 or 3 weeks. They needed it right away.
This is all on the government and the big banks essentially saying no to anyone who wasn't a customer. And it fell all on the backs of fintech companies to say, all right, do you want this money in the market? And if you want this money in the market, and they did as fast as humanly possible, they had to know that the risk of fraud was there. And I think them coming back after the fact, after all that pressure on the front end, saying, oh, your underwriting, your fraud detection capabilities should now be investigated and penalized, I think it's just completely unfair. And I think a lot of this should fall back onto the government, not onto the fintech platforms that served a program that kept millions of people employed, us included. Yep. Peter, you wrote about the PPP stuff for our company. And I just think it's crap that companies like this need to deal with it because the government wants to act as if, oh, how couldn't you know this?
Well, I remember. I remember like the Friday that PPP launched, I remember Senator Rubio was on Twitter a lot of that day, and Wells Fargo was only lending to, no, it was Wells Fargo, it was Bank of America, I think, that was only lending to their existing customers. And only if you had, like you couldn't, even if you had a credit card with Bank of America, that wasn't good enough. And I remember like people saying, you guys have got to open up, and Senator Rubio on there saying, you guys have to start lending. So all this pressure, they forget about the pressure at the time to lend, and now they complain that there was fraud. I feel like obviously we live in an ideal world that we could have done both, but I think it was either or back then, and I'm glad they chose to get the money out.
I know, totally. Yeah, it's always you can always act. I mean, Monday Night Quarterback, but if you had to relive that time.
Do the same thing again.
Yeah, do the same thing again. Exactly. Yeah.
Okay, we're going to end with a more lighthearted story here. We're going to talk about the Kardashians.
Oh boy!
All right.
Who is Kardashian? I don't even.
I've never talked about Kim Kardashian on this show before.
First day for everything.
She was promoting on Instagram to her, I don't know, hundreds of millions of followers she has, a crypto asset called Ethereum Max. She was paid $250,000 for one post on Instagram. and she didn't disclose that she was paid. And now the SEC said, you know what, that's still like $1.26 million fine. And the thing that's interesting there is it's just there's plenty of celebrities endorsing all sorts of things. I mean, you got Tom Brady and Matt Damon and many others. And now it seems like if you're endorsing something just on social media, the SEC wants you to actually tell people you were paid.
Well, I guess Matt Damon probably had a good lawyer to tell him he had to disclose, and he didn't get a slap on the wrist. But poor Kardashian.
Right, poor. Yeah, she's worth I think like 1.5 billion or something, and she's been fined $1 million.
Exactly.
Yeah,
not that big a deal. Okay, that's all we have time for today. So
what a place to end.
Yeah, what a place to end indeed.
Yeah.
We probably will not be talking about Kardashians next week, but do tune in same time, 5 p.m. Eastern. Todd, myself, and a special guest will go through the news of the week. Thank you so much, Dan. It was great to have you on again.
Good to see you, Dan.
Great to be here.
Have a great evening and weekend, everybody.
You too, guys.
See ya.
Bye.